The US economy faced significant challenges during the 2000s. The recession at the beginning of the decade, the 9/11 terrorist attacks, the decline in jobs within the US manufacturing sector, the subprime mortgage crisis, and the 2009 recession. Mortgage loans are classified as either prime or subprime depending on their credit risk. Subprime mortgages offer higher yields than standard mortgages, and consequently, these mortgages have been in demand for securitization. Securitization is the financial practice of pooling various types of contractual debt, such as residential mortgages, commercial mortgages, auto loans, and selling them as derivatives. Securitization is one of the main reasons of relaxed or predatory lending practices. As can be seen in this graph, housing prices were inflated between 2001 to 2007, even as the building cost index decreased. Predatory lenders had a very powerful deceitful tool called hybrid adjustable rate mortgages, as we can observe on Yahoo Finance. As you can see, these types of mortgages have the lowest interest rates. These loans have a fixed low interest rate for a set period of time, in this case 5 years. After 5 years, the interest rates are reset to a benchmark rate plus associated risk premium of the loaner. Deceived by the lower rates, the subprime mortgage loaners got the bad loans, hoping to refinance before reset date. Predatory lenders did not care about it because they had their commissions. Banks who hired them just converted subprime and prime loans into securitized derivatives. These derivatives then were sold to investment bankers. Investment bankers marketed these securities to a wider range of customers. One of the primary buyers of mortgage debts was a gigantic risk magnet insurance firm, AIG. AIG bought much more securitized mortgage risk than they could afford. When the interest rates were increased by the Fed in fear of inflation from 2004 to 2006, the subprime loaners found their payments increased by 30%. A lot of these subprime loaners used their right to default on the loan and gave their houses back. This put a pressure on the housing prices, which already was inflated. As the year 2006 and 2007 progressed, the housing prices in the USA plummeted, turning the risks sold to a time bomb because the loan risks sold were no longer worth the price they were given at. In fact, the relaxation of lending standards was welcomed by everyone at the time. The 2008 film Yes Man is a fine reflection of it. In the film, when the bank headquarters learned that one of their branches relaxed their lending standards, instead of firing the employees, they award them. Banking and mortgage institutions were turned into yes people, but for a good reason on their behalf. We believe the problems leading to economic crisis have its roots way back. The low interest rates Fed applied between 2001 to 2003 are widely blamed for causing excessive lending. The response defending this policy came from Elaine Greenspan, who was the Fed chairman at the time.
One of your former Fed governors, Ed Gramlich, said that he proposed that the Fed examine these lending practices and look into them to see if something could be done, and that you rejected that idea.
Well,
Why did you reject it?
I thought that we would not be capable of doing what he was suggesting.
What, of sitting on them, taking some regulate, what?
Well, I think not.
Even if you even looked into it?
Well, there's nothing to look into particularly because we knew that there was a number of such practices going on, but it's very difficult for banking regulators to deal with that.
He also claims that Fed did not have the power to determine the long-term interest rates alone like mortgage. Translating his words into English, US Treasury bonds which determined the benchmark for long-term interest rates were set by foreign demand, mostly from China, than the Fed acquisitions did. As this policy indicates, currently the monetary policy makers are not able to set effective tools to control the implications of monetary policy independent from outside factors. Adding to that, the US workforce's real income increased steadily from 1890 to 1980. From 1980 to 2014, the real wages have been stagnating. However, the productivity is increasing steadily. 1980s were marked by decreased tax rates, deregulation, and liberalization of financial markets. To be fair to Bush Jr. administration, they mostly went ahead to continue the policy of deregulation, but made the most striking exception to this long-standing policy by signing Sarbanes-Oxley Act. The distribution of wealth has also affected the investment and consumption habits. As the higher-income Americans grew richer, their appetite for investment and risk has increased. The overall savings level, however, decreased, relying on other countries' savings. This has created an imbalance in the economy that the US is dependent on other countries' savings. The US economy has been through several business cycles since mid-70s, but the one after mid-2007, set off by the burst of the housing bubble, was the worst of all. The GDP growth went down and never had the momentum it usually gained after a recession like this. Let's look at two recent recessions to see how subprime crisis impacted the GDP and how the economy is different than what we had before. The first one is the recession in 2001. The growth of GDP goes down to less than 1% in 2001, reached the recessionary trough, and then started to pick up. 2004 is the expansionary peak, and then the growth of GDP slowed down and entered another recession in 2008. This is a full business cycle, but what we are about to see about the recession started from 2008 after the subprime crisis is different. Unlike the previous recession with a less than 1% GDP growth rate, the economy dipped down to a negative GDP growth in 2008 and even worse in 2009. In 2010, GDP growth finally was back to positive. However, the growth slowed down the year after. As a result, it is questionable whether or not the US economy has truly recovered from the recession in 2009, or whether this up and down trend during the years after the crisis represents a double-dip recession. Here are the four components of US GDP in 2012. The consumption dropped a little bit to 68% from over 70% before the subprime crisis. Government spending is the second largest component of the US economy. Let's take a look at how the national debt to GDP, which reflects how government spending changed after subprime crisis. From 1994 to 2007, in most years, the national debt to GDP was stable around 65%, and in some years, like the late Clinton boom in late 90s, the change in debt to GDP ratio is negative and dropped down to 56%. Even during the 2001 recession, the debt to GDP ratio didn't increase dramatically, only increased by 2.8%. In contrast, the debt to GDP ratio jumped by 5% and 15% in 2008 and 2009 respectively, reacting to financial crisis, but also increased another 10% after the GDP was restored at the same level before crisis. In 2013, the ratio increased by 3.3%, still more than any year between 1994 and 2007, and the ratio is now at 106%, just a little bit lower than the historic high of 113% as in World War II. The stock market has been doing well since 2009, and most of the public companies delivered better than ever profits in previous years. But as a matter of fact, the private sector investment has never got back to 20% of the GDP. Before the crisis, the percentage was around 21% to 23%. This might indicate why the seeming recovery was accused as the jobless recovery. In the beginning of the first decade of the 21st century, the unemployment rate in the US remained quite low, below 6%. In 2007, after reaching the lowest 4.4% in March, it began a long unilateral climbing, which reached its climax in October 2009 at 10%. Up until now, the US unemployment rate is still above 6.6%, and the economists are still debating the outlook for this year. We would like to understand if subprime mortgage crisis was responsible for the soaring unemployment. If yes, how? We begin our analysis from three perspectives. Let's take a look at the jobs lost by industry. The top three industries that had the most job losses are manufacturing, construction, and professional and business services. The subprime mortgage crisis had a direct impact on industries such as construction, real estate, rental, leasing, and financial industry, in which layoffs took place as a direct consequence of the burst of the housing bubble. As the housing market collapsed, There were less need in construction sites and real estate rental and leasing. A good number of jobs lost in the financial industry took place in mortgage and subprime lending institutions. After careful analysis of the Beveridge curve, named after economist William Beveridge, we concluded that the unemployment during 2009 and 2010 were generally cyclical. There are three key factors which impact consumer expenditures: taxes, consumer sentiment, and government economic stimulus. Customer sentiment in the United States started to decline after the occurrence of the subprime mortgage crisis at the end of 2007 and reached its lowest level since 1996 at the beginning of 2009. The 9/11 and Iraqi war had less of a significant influence on consumer confidence, as did the crisis. The typical US householder experienced lower than normal expectations of normal economic growth and consequently reduced the amount spent on goods and services. As a result, consumer spending, one of the largest components of GDP, decreased in line with the decrease in consumer confidence from 2008 to 2010. Average householders are losing their faith in the economy and lowering their expectation of the growth, so they do not spend as they used to. The retail US sales year-over-year growth rate has decreased sharply during the subprime mortgage crisis.
Good evening. This is an extraordinary period for America's economy. Over the past few weeks, many Americans...
The response of the government to the crisis, as you explained, has been massive government spending with moderate success. The video you are currently watching is the 1982 film Koyanis Katsi, which in Hopi language means ecosystem out of balance. And that is exactly what we think about the current economic climate in the USA. Koyanis Katsi.